Hi everyone, welcome back to Be Rich. And this is the third video which I have with Sashwath. I hope you enjoyed the first two. And this one I thought I'll debate with him on certain ideas of investing. One of these things you guys have always been asking me on what you call in comments and when I meet you in person is how do we analyze and how do we pick? How do we know when to buy the share and how to buy the share? So we have always spoken about how to do analysis. And there is an argument, a school of thought, which is what I'm going to debate on that side. While Shashwat will probably take the other side of the debate and argue how analysis, yes, though useful, in this instance, it doesn't hold much use. I'm talking purely in the sense of all these things known as resistance levels, breakout levels, and when to buy the share. After doing fundamental analysis of a company, we decide, okay, we're going to invest in this company. Then gets into the timing, when to purchase this, when is the right time to buy it. And this problem is very prevalent right now because our market is currently going through a bull phase. And it's been going on through a bull phase for quite a long time. And though the slight blimp was there during the election and the election day results, the market seems to have picked up steam again and it's again running on a bull phase. At this kind of a juncture, most people would refrain from really investing in the market because they'll be like, wait, everything is overpriced. There's no real point. But in case in point, if you look at, is one of Anand's favorite stocks, which he's there on his patas list, as they say, and he's asked you to consider this quite a bit, is Natco. Natco, even today, as we were recording this video, went up by 3 or 4 percentage points. And it's still a very good value buy at the PE ratio where it's standing at compared to its peers and its historic PE ratios itself. If you look at the mean, so if you look at it like that, it's a great buy. But do you buy it now? And I will be putting up a post on Medium, on my Medium page, giving you more insight about this so-called breakout and how to buy it in this 8-week rule. That if you see your stock gaining over this 8-week period, then you should look at holding on to it for a longer period, maybe a few years or more, or even longer, because you're going to see very handsome returns than the 20% or the 10% or 15% you would have seen in the short game. Shashwath is of a different school. He says, Mama, only thing that's important is the value analysis which you do in the beginning to see the intrinsic value in terms of what the business is. Then the current price where it is. He says the rest of it is just noise. So you're going to hear both sides of this argument. I've laid out the field to you now. We will first hear Shashwath's take on this analysis on so-called breakout and all this graph analysis, looking at 200-day moving average, and if it breaks that ceiling, does it all hold anything, Shashwath? What do you do when you look at all this number? What I'm saying.
First off, I'd like to preface that I have no familiarity with day trading, and I'm not.
Yeah, this is not day trading at all.
Yeah,
actually.
Yeah. So I'm not familiar with these
terminologies.
Terminologies, and I had to familiarize myself. I mean, I've come across them before.
Yes.
When I first started investing, and I had to refamiliarize myself with these terms for this video. But I'm of the opinion that it's like buying a property. You look at what yield you get out of that property, and you see what people are selling that property for, and what you think according to the yield and the current rate of interest is, and then you figure out about how much you'd want to pay for that property based on what kind of percentage return you want. That's simple arithmetic. Maybe a little more than your addition, subtraction. Maybe you might have to do some division and multiplication to the power of exponents, but you'll get to that answer quite simply. Maybe it might take a little bit of time to get to that number, but you will, I promise you, get to that number. So when you look at a stock, let's treat a stock the same way. What is a stock? A stock is one share of a company. What does one share of a company entitle you to? Part ownership. Okay, so that's great, Sashwath. There's part ownership of a company. What does part ownership entitle you to? Well, part ownership entitles you to a portion of the assets of the company, a voting right, which you get to exercise depending on what class of stock you buy in USA. But here, generally, you do have voting rights. And 3, it gives you a portion of the earnings depending on whether the company decides to pay out the earnings or not. The company may well decide that, hey, the majority of shareholders think that the company is better off taking retained earnings and reinvesting it back into the company. That's very much possible. In that case, you may not be receiving a dividend, which is what Berkshire Hathaway does. But let's take the normal case where a company pays out a small portion of its earnings as dividends. So you have something called the dividend yield, which is about generally ranges about 1 to 3% in most companies. So you don't have more than that usually, or less than that usually. Less than that, it happens sometimes. But the point is, it's somewhere between 1 to 3% of the share price, the dividend amount. Okay, that's great, Sashwath. You've laid out dividend yield, you've laid out a portion of the assets, and you've laid out voting rights. What does this actually entail in terms of calculating that arithmetic number of how much the stock is worth? I'm glad you asked, because the way you calculate this number is by looking at what sort of return you want from your stock. That is, what rate of return. So say the interest rate in India is 6% or 7%, and you want maybe 2 to 3% more than that because this is equity. And suppose you want your stock to return 10% per annum, which is reasonable, very reasonable. I'm actually underrepresenting how much you'd want out of your equity. You'd ideally want more than 10% per year. But let's just go with a safe assumption of 10%, which the index should be able to return you over a long period of time. Let's talk about this 10%. So for me to get 10% per annum in the next, let's say for the next 10 years, 15 years, 20 years, how much do I have to put out today in terms of price of this stock? That is the number which you have to calculate using discounted cash flow, but depending on how much earnings is coming into through your company. This is called the DCF method, or discounted cash flow method, where you basically say, year one, my company is going to make so much in earnings, out of which this portion is mine. Year two, it's going to make this much. Year three, it's going to make this much. You factor in depreciation and what other costs you want to factor in. Please factor them in. And finally, you will get this absolute number, which is the return you're getting in the company. So based on these fundamentals, then you can set the discount rate to whatever you want. So you can set the discount rate to say 10%, which is the rate of return you're expecting. And if after discounting the stock, you finally get to this present day value, net present value, and if that net present value is above what the stock is trading at currently, you go ahead and buy it. Because look, you are valuing this stock at, let's say, 100 rupees according to net present value. If you pay 100 rupees for the stock today, according to your estimates, the stock will give you a 10% return over the next 10 years, like year on year. But the actual price is below that 100 rupees, which means that you're going to make a much larger return according to your own numbers. So you go ahead and buy it because it's below your intrinsic value, the bar you have set. Now, a lot of us don't have the time to do this discounted cash flow method, which is why we look at the PE ratio method. So the PE ratio method is almost like a shorthand. It's like it's a quick, dirty heuristic which we can use to get not a wonderful idea, but a fair idea of how things go. So PE is basically saying, look, this is the price, this is the earnings. Currently, the ratio is this much, price to earnings. Very simple metric. You can calculate it yourself with EPS and price. So the PE ratio, what it basically ends up telling you is it acts as a yardstick to compare this company with how much its earnings are currently in the past 12 months and what the price is trading at. And you can compare it with its peers, and you can see whether it's trading cheaper than what it used to be trading, whether it's trading cheaper than the average in the industry, whether it's trading cheaper than the average of the index. So that's why a PE ratio is very important. Now, given that I've given you this information, discounted cash flow, for those of you who have more time and are feeling more speculative, and the PE ratio for those of you who don't have so much time but have a general idea of how the market works and want a good idea of what valuations are. This is the value investing method, where you try to buy something for less than it's worth. Now let's come to the method which is being prescribed here. So the method prescribed with trying to tie in price signals and resistance levels and support levels is that you also, on top of finding a company which is valued correctly, you're trying to also time the market. So you're saying that, look, I love this company, it's valued very well, but what if I can squeeze a little more out of this deal? What if instead of buying it for 80 rupees on the 100 rupee note, what if I can buy it for 50? What if I can buy it for 40? Or let's say, suppose this company is worth $100, but I also know that the market tomorrow is going to value it at 130. So even though the price is trading at 110 and I know the true value is 100, I can ride the wave till 130 and sell it at 130 and then buy it back once it falls to 100. or below 100. This is what, at least I believe, is trying to add price analysis into fundamental analysis. Well, let me make this amply clear. It's very difficult to do this because if you look at all mathematicians who are working on financial markets, they model stock prices through something called Brownian motion. For those of you who have done chemistry and physics, you'll know that Brownian motion is a random walk, in the sense that if you have a person and you don't know what they're thinking and they're just walking randomly in a set series of steps, they say that particles also follow the series of steps in entropy. So particles move in random ways, which is how stock prices also are supposed to move according to the Brownian motion method. Because very skilled mathematicians have been unable to really find an underlying way in which stock prices move. There's a lot of noise in the short run. In the long run, it's a completely different story. But in the short run, there's a lot of noise. So the problem with this method is, yes, sometimes you're right. Instead of going to 130, it may go all the way up to 120. So you may make $10 going from 110 to 120. But the point here is that you end up focusing so much on moving from 110 to 120, you end up leaving an opportunity which in the long term is going to make you 1,000 rupees. So for 10 rupees in the short run, you're so fixated on it, you end up forgetting what the long run picture is. That's a big flaw which I see to the sort of resistance and support level analysis. And two, support levels and resistance levels are computer generated. They're done through statistical analysis, and there is no reason why tomorrow these support levels and resistance levels should change, at least from my understanding. And if any of you there actually can tell me whether this is wrong, I'm happy to hear it in the comments. So from where I stand, I don't see anything concrete in price analysis which is going to deliver me value in the long run compared to just giving all my attention to value investing. If I'm doing value investing, for the time I have to make 10 rupees on a 100 rupees share, if I put the same amount of time into value investing, I could be finding the next Coca-Cola which Warren Buffett picked when he was in his prime, or I could be finding the next Seas Candy if I spent this amount of time in value investing. Because price analysis, believe it or not, takes a lot of time. You have to do a lot of chart analysis, which may or may not result in a fruitful outcome. So for those of you who want to make money in the long run and don't mind foregoing some instant gratification in the short run, I would argue that value investing is where your time should be spent, because there's more returns to the amount of time you're spending there. This is what I think.
So there you go. So I'll put up this piece, whatever is there in my iPad, on my Medium page. Do read it. Then I want you to come back here and feed in the comments column on what you think. Which school of thought are you in? Which camp do you lean in, and why? And you can argue both sides, and we would love to read what you guys think.
I'd like to add one more point.
Sure.
There's this investor known as Sashwath who does very good discounted cash flow predictions. He in fact talked about the Adani Enterprises company in his discounted cash flow stock analysis, and he talked about what Adani's true valuation was according to him. So he's called the Dean of Value Investing. If you guys want a model, because a lot of you keep asking him and me, we're not experts on discounted cash flow analysis, but if you do want an expert view, we suggest you go to Sashwath and see his writing.
And buy his book and read it.
Yeah.
This little book of valuations. Anyway, so that said, do read and do comment down here on what you feel and what you think. But remember, in both, whatever we are saying, end of the day is you have to buy it and you have to hold it. You have to hold it for a long time, and that's the whole principle behind value investing, is holding it. You have to allow the tree to grow and bear fruits. So remember that in both schools. One is arguing, saying what Shastra is saying, you spend time finding the company once you have done your fundamental value analysis to move in and start buying and not worry about timing it. The other tries to take a further step and saying, not only should you do that, you should also try and time the market, which I do agree with him, which is next to impossible. But the reason why we picked this today was because a lot of you have been asking us to address this. When? So this kind of talks about this in further detail. We would love to hear your thoughts and feedback on this too. Thank you for watching the video today. Do put in your comments down below. We would love to read them. See you again in the next one soon. Bye.
It's a great privilege and honor that so many of you in thousands have subscribed to my channel and have supported me. I have written 2 books in English, The Alchemy of Money and Ordinary Stocks, Extraordinary Profits. These books are published by us and are ready. If you want to procure a copy, send us a message to the WhatsApp number given below and my team would respond to you. If you want an Amazon Kindle copy, you can click the link below. Finally, those who wish to consult with me can send a mail to berichenglish@gmail.com. Once again, I thank you for your support. If you like this video, press the subscribe button of my channel, hit the like button and turn on the bell notification.